Every company you've ever heard of, Apple, Tesla, your local bank, they all have one thing in common. At some point, someone had to decide, where do we put our money? How do we raise it? And how do we make sure we don't run out of it? That's corporate finance. And by the end of this video, you'll understand exactly how it works. Corporate finance is the system a business uses to make smart money decisions. Not accounting, that's recording what already happened. Not economics, that's the bigger picture. Corporate finance is about decisions, specifically 3 of them: where to invest, how to raise money, and how to manage cash day to day. Get these 3 right, and a company grows. Get them wrong, and even big companies collapse. The first decision: where should the company invest its money? This is called capital budgeting, and it's basically asking, is this project worth it? Say you run a bakery. You want to buy a new industrial oven for Rs 500,000. It'll let you double production and bring in more revenue. But should you do it? That's where 3 tools come in. NPV, net present value. It tells you whether the future cash you'll earn is worth more than what you're spending today. If the answer is yes, the project adds value. IRR, internal rate of return. Think of it as the project's profitability percentage. If it's higher than your cost of borrowing, go for it. Payback period. Simple. How many years until you get your money back? Together, these tools stop companies from making expensive mistakes with their capital. Now, once a company decides to invest, the next question is, where does the money come from? 2 main options. Debt. You borrow through a bank loan or bonds. The upside: interest payments are tax deductible, making debt cheaper. The downside: you're now obligated to repay, which adds financial risk. Equity. You sell shares of the company to raise money. No repayment required. But now you've diluted ownership. Existing shareholders own a smaller piece. Imagine that same bakery, now grown into a mid-sized food company, wants to open 3 new factories. Do they take a loan and keep full control but add risk? Or sell shares, reduce risk, but give up some ownership? This balance between debt and equity is called the capital structure, and finding the right mix is one of the most important decisions in corporate finance. The third decision doesn't make headlines, but it kills more businesses than the other 2 combined. This is about surviving day to day. Even a profitable company can go bankrupt if it runs out of cash at the wrong moment. Think of a grocery store. The owner needs cash to restock shelves every morning. They need to manage inventory. Too much, and money is stuck in unsold goods. Too little, and shelves go empty. They need suppliers to give them 30 days to pay, while customers pay at checkout immediately. That balance: cash, inventory, receivables, payables, that's working capital. Manage it well, and operations run smoothly. Mismanage it, and even a profitable business can't pay salaries. Here's the real-world proof. In 2008, General Electric, one of the largest companies in the world, nearly collapsed. Not because their products were bad, but because they had taken on too much debt and mismanaged their capital structure. Their fix? They sold major assets, cut their dividend, and restructured the entire business. Corporate finance decisions, made at the top, saved or destroyed billions of dollars of shareholder value overnight. So to summarize, corporate finance is 3 things: deciding where to invest, deciding how to raise money, and making sure the business stays liquid every single day. Master these, and you understand how every successful company actually operates. If this helped, subscribe, because we're going deep into each of these topics one by one.